Today, I'm going to share the one reason why the average investor underperforms the market. My name's Joe Conroy, and here at Hartford Retirement Planners, we put all of our time and effort into making sure that investors aren't making this one mistake. And I'm going to share that with you right now. Let's take a look at a chart from JP Morgan, which goes through several different investing categories, and I'm going to highlight three of them. So as you can see by the chart on your screen, it shows in green the S&P 500, and this is over the last 20 years, has averaged an annualized return of 9.5%. Most people aren't invested completely in stock, so let's take a look at a 60-40 balanced portfolio just for illustrative purposes. 60% stock, 40% bonds, was up 7.4%. Keep going to the right of the chart. In an orange box, you're going to see the average investor is only up 3.6%. So why is that? So that's what we're talking about today, is why the average investor underperforms the market by a significant amount. Now, as much as we want to think that we can take the emotions out of investing and we're purely looking at it in order to make profits and grow our portfolio for the future, I think we'd be doing ourselves a disservice if we completely discount the role emotions play into our decision making. And let's look at a different chart. As you can see here, this is the emotional cycle for investing. So the market goes up and the market goes down, right? Everybody knows that. But there's emotions that attach to it. So, for example, the last couple of years coming out of COVID, the market's been going up. It's been easy to be an investor in a rising market. Put money in, it goes up a little bit more. You put more money in, it goes up a little bit more. We get this positive reinforcement. However, the market doesn't go straight up forever. And on the other side of things, the market starts to decline. Now, the declines don't last forever, and up to this point, the market's never gone to zero. But you can see on the screen a couple of different emotions as things drag on a little bit longer and go a little bit further south, emotions get a little bit stronger. So put in other words, it's easier to buy things that are up because there's a track record, and it's emotionally easier to sell things when they're down because we want to avoid loss. Let me share an analogy real quick, all right? So let me put it in other terms, because if you're watching this video, you probably know I'm a big analogy guy. If we go to the car dealership and we're in the market for a pickup truck, we go and the dealership says, hey, great news, these trucks are in super big demand. There's going to be a 30% premium above sticker price for this truck. And we think, that's fantastic. I'll take 3 of them, right? It doesn't make any sense to those that are watching this, right? And if we go to that dealership and that same truck that we want, hey, you know, these trucks are out of favor right now, and I know you really want this specific truck. We're offering it at a 20% discount. You think, oof, you know what, never mind. Why don't you call me back when it's 30% above sticker price, and then I'll come back and I'll buy a few of them from you, right? We wouldn't do that. That's the opportunity that down markets present to us when it comes to your investments. So how does the average investor get caught up into this emotional cycle of buying high, selling low, and as that previous chart suggested, doing that until we're broke, right? Let's take a look at another chart, and this is going to be the S&P 500, so stock index. We're going to shorten up the time frame. We're going to look at it going back to 2006. Going back to 2006, as you can see, the light blue line, it trends up and to the right. But there are dips, and if you think from 2006 to now, has it been a super smooth ride, or have we had 2 major recessions and 2 major bear markets? So we had 08 and 09. We also had COVID, and there was a bunch of smaller speed bumps mixed in there as well. Now, if you're looking at this chart, you see the blue line. You probably see the red and the green bars. That's trading volume, monthly trading volume. So not super important, but if it's a question that you have, I figured I'd answer it. And let's talk about market recoveries. Going back to 1929, there's been 26 bear markets, and there's been 26 recoveries. We're batting 1,000 on market recoveries for every single time we've had a bear market. Anytime the market's dropped, up to this point, it's always recovered. Now, can I guarantee that's going to continue forever? I can't. Can I guarantee that this market is going to recover? Nobody can. But 1,000% batting average going back 100 years, I think is a pretty good indication of what's to come going forward, right? And some people will say, yeah, but this time it's different. Well, every 26 of those different bear markets that we had in the past were for different reasons, right? The outcome is the important part. And that's been the same, full recovery. All right, so keep that S&P chart in your head. We're going to look at a different one, and then we're going to combine them together, and I'll get to my point here, okay? So this chart comes from Bank of America. It is from their global research division. and it tracks investment flows. So that horizontal line that you see is the average inflow or outflow into investments or the stock market. Anything above that line, the little squiggly line, if it goes above, that means more people are buying than selling investments. And if it dips below that line, it means more people are selling their investments rather than buying. All right, now before I combine both of those charts together, keep in mind I'm a financial advisor, not a graphic designer, so the chart isn't the prettiest, but hopefully the point comes across, and let's focus on the information. So here we can see both charts are combined, and this is again going back to 2006. What you'll notice is as the market goes up, that thin blue line, fund flows or investments pour in. People are buying stocks as the market is increasing. And when the market decreases or hits some turbulence, funds go out, meaning people are selling their stock-based investments. Mutual funds, ETFs, individual stocks, whatever it is, right? They're selling. And if you look at this chart hard enough, you notice there's a little bit of a dip, although it didn't feel like a little bit of a dip. But back in 2020 with COVID, we had a very sharp drawdown. Look how quickly people started selling their investments and shedding themselves of stock investments. And then as the market recovered, people felt more and more comfortable, but it took a long time before they felt comfortable getting back into. Now this chart stops in the year 2021. As we know, as I film this in September 2022, the market's been on a downward trend and hasn't quite recovered yet. We're 9 months into a bear market. And as my granny would say, I would bet you dollars to donuts that if we look at the fund flows, people are selling out of stocks as they're dropping. But wait a second. Obvious statement of the year, isn't the whole point of investing buying low and then selling later at an increased price for a profit, right? And you might say, but what if it doesn't increase? Well, what if the last 26 times don't repeat for the next 26 bear markets over our children, grandchildren, and great-grandchildren's lifetimes, right? We got bigger fish to fry if we don't have any kind of economic recovery in the next 10 years. That's going to be a real big problem. So if this time's like the last 26 times, I think we're in good shape. You might also be watching this and saying, but Joe, I'm retired or I'm getting close to retirement. I don't have time for this recovery. The average recovery takes maybe 1 to 2 years for most bear markets. We're 9 months in. Could take a little bit longer, probably will take a little bit less, but there will be a full recovery, and retirement isn't when you pull all your money out, right? This money is supposed to stay invested and balanced throughout your retirement to hopefully sustain you for the next 10, 20, 30 years. So just because you're at or around retirement doesn't mean you're a short-term investor. You still have a few decades left, hopefully. At least we hope so. So I'm going to finish with a story. We're watching, my wife and I, a show on Hulu. It's called Dopesick. It's a great show about a terrible topic. It is the rise of OxyContin and opioid use in the U.S. So, as you know, OxyContin is a pain medication based on opioids, and it was overprescribed. But anyway, point of the story, I'm not going to give you any spoilers, so if you're looking for a good series, I would watch it. There's a scene in there where the company Purdue Pharma, who made OxyContin, is trying to get the drug into Germany. So the executive in charge of getting this approved and distributed into Germany to try to get into the rest of Europe is hitting some resistance. And the top Purdue Pharma guy says, what's the deal? Why are we hitting all this resistance? He said, to put it simply for you, it's a cultural thing. Here in America, we've got these pain charts in the hospitals. We avoid pain as much as we can. That's just a little bit more accepted. But in Germany, culturally, they have suffering as a part of the healing process. So while they don't like pain, they view it as a part of what gets us to the other side, which is hopefully recovery or healing. So they don't really have an interest in pain medication because they don't really think it's all that bad. It's just temporary. So I think you know where I'm going with this, but I'm going to hit you over the head with it anyway. Suffering is a part of the investment process. And if you don't have at least a little bit of agitation or some type of pullback, it means you're probably too conservative and you're going to have a tough time keeping up with inflation, especially at these levels. But there is no magic pill that's going to avoid market losses and give you the upside that market has to recover. We know from the past that every single time looking backwards that the market's recovered, but we do have these market cycles that we have to go through from time to time. It's a little bit of the suffering, but we get through it. And I filmed this video here because this is the very spot where I filmed a lot of the videos for COVID that helped a lot of the clients I work with get through those times, and we're better for it now. I wish we had a few more years of upside before we had another market cycle with downward pressure, but we'll get through this one too. I'm confident in that. Let's not fall into the mistakes that the average investor makes. Let's be above average and look at downside as opportunity. And if we don't have money to invest in this market, we'll at least hold the line. And if you're not sure if you're positioned for the upside, you can certainly reach out to a qualified financial advisor. We're having these conversations all the time with clients and potential new clients. And as always, thank you for watching.